Hey everybody, we're the Startup Brothers. I'm Trace Cohen,
I'm Maxwell
and
Cohen.
this is my brother. And we are here to talk about current trends in tech, what's going on in the markets, and maybe some value add based on our experience. So, as I mentioned, Trace Cohen, I've been in the tech world since 2008 when I started my first company in college, started a few more companies, and for the last 5 or 6 years have been making angel investments really early at the pre-seed and seed. I'm active on Twitter, I write a lot, and now I like to talk. And this is my brother. He's on the opposite side.
Hey guys, I'm a founder. I started my business in college. This is Peel Away's a fitted bed sheet with 5 soft, 100% waterproof peel away layers. Just peel off the ew and sleep on the new.
Yeah, so I wanted to start today talking about what's happening in tech. I had breakfast with a friend of mine who's running a phenomenal cash flow business. We don't use that word often. And he was saying that one of his kind of sponsors or advertisers is slowing down. He named the company. I was like, yeah, that makes perfect sense because that's what we're doing. And so ever so often I have to kind of take a step back that I live in the world of tech and 99% of the world doesn't live it second to second, where I see what's going on Twitter by the moment on Reddit, and I follow the news. And so I kind of just wanted to take a step back and somewhat explain what's going on. I'm not giving you financial advice in terms of what stonks to buy, but I want to let you know why we believe that stonks and the private markets, the venture capital and startups are somewhat correlated.
Yeah.
So you read all the headlines over the last year or two that this company is raising hundreds of millions, billions at a multi-billion-dollar valuation. Why? Because the private markets are correlated to the public markets. X company was public at a 50 to 100x their revenue. I don't want to say earnings, I don't have that, but they were growing. We used to be, and I'm calling the end of the growth era, at growth at all costs, right? If you watched We Crashed, I'm watching it now, and I was the 400th member of WeWork, so I kind of went through it and saw a little bit of the inside. That he was saying we're IPOing with 1.9 billion in revenue, but also 1.9 billion in losses, give or take, which is crazy. But he was growing at 50 to 100% year over year. But it got a little too crazy, and people were paying until they didn't. It was kind of a game of musical chairs. And so, how does this work? A venture capitalist, if you want to know kind of how the economics work, have this game that they need about 10% of your company. So, assume a company raises $100 million. You can then assume the company is worth 1 billion, give or take, depending on what their growth is. And so, at exit, they need about 10% to make their fund return. So, I always tell founders, do you understand the economics of the VCs that you're pitching? Because you're raising capital, but they also had to raise capital as well from LPs. And who are these LPs? These are endowments, high net worth individuals. They're companies. They're other investors who are kind of ancestrally investing in other funds to kind of diversify and get other deal flow. And so Max has raised millions of dollars for his company. And do we know where all those investors got their money from, what their expectations are? It's kind of crazy. And so a lot of people didn't ask that, but now that people are seeing the returns come down in the markets, it's starting to hurt the private markets as well because yeah, you could IPO get acquired for 50 to 100x, but now the public comps are saying, well, maybe closer to 20 to 30. So you raise a billion valuation with maybe 4 or 5 million in revenue. Now that's probably getting closer to 100 million to 250 million valuation. So your multiple has gone down and your expectations have gone up.
Yeah.
And so it's getting weird out there. Now everyone's kind of pulling back on their investments, and all the VCs or value adds kind of flipped and basically said, well, you need some runway. Money isn't cheap these days. Interest rates are still 1%, which is kind of
Yeah.
ridiculous, but money isn't flowing like it used to. And so everyone's saying, cut back. And there's a website, if you go to layoffs.fyi, that we can unfortunately see all these companies laying off 7 to 100% of their company. Big names that you have heard of. Klarna, they laid off 10%, which is 700 people. Gorillas, all these 15-minute
Oh
delivery
my,
companies, they just laid off 50% of their
so
company,
silly.
about 300 people.
Yeah.
I never used it. I live out in suburbia. Max possibly used it.
I just go
Amazing
outside and pick up
services.
my groceries. It's down the block.
Right, but you want something late night, which is like a Go Puff. That's how they started. And they raised billions of dollars, but they never became profitable. These terms of economies of scale never really kicked in. Uber, that was 100% subsidized by
Yeah.
VCs and eventually the public markets. And now it's actually cheaper to get a cab than it is an Uber
Yep.
because we don't fund it anymore. It's public. A lot of VCs are either cashed out or they can't raise money or they have to actually make money. If you spend a dollar, you have to make more than a dollar. So we're getting back to more rational, less exuberant times. And this is just the markets. If you can IPO
Yep.
and grow at X amount and people accept it, that's okay. And so, at least from like Max's perspective as a founder, I don't know what your investors have told you. I know that we have been working on margins, and we were discussing
Yep.
before this how to squeeze out every percentage margin you can and extend your runway.
And you might do things that you would never do, before these trying times. What I've learned is it was the VC's fault, the public market's fault in many cases for encouraging us entrepreneurs to just grow at all costs. There was 10 years of raising capital based off of future, you know, give me your most accurate forecast, right? To me, that's an oxymoron. These companies, in many cases, are growing so fast or have no growth at all and projecting, the future that, they don't know the answer to, especially when the times can turn. What we've, as I said in the last episode, something I learned that's dramatically important is always be in crisis mode. So, we were all pushed, raise money, get as many customers as you can. Doesn't matter the cost. But now the world, from my perspective, has to be a happy balance. Crisis mode doesn't mean stop everything. These downturns don't also mean don't stop scaling and growing. So what I've been doing personally is I've been trying to find a happy balance of growth, maintain, and scaling back. I know they're all oxymorons, but this whole game is an oxymoron, and as you can tell, a lot of it's
Right.
just
It's like
arbitrary.
spinning multiple plates at the same time.
Oh
So
yeah.
that's to keep them going.
Well, and that's one of those wonderful examples. I feel like a madman running a business, as a sole founder with a few small team. Let's just say that. And Trace's example is perfect. I feel like I'm at a circus spinning those things, those discs, and I have 30 discs. And in these trying times, some discs you want to keep spinning tight. Some discs you just say, you know what, let them fall, let them fail. It takes too much of my time. The margins are not worth the business. And then some discs are shaky and you're trying your hardest to keep it up. But that's the careful balance. Make sure the discs that are beneficial to you are spinning tight, and the other ones, if they're not as important, you must prioritize. There's no ifs, ands, or buts in this environment.
And that's what us investors are telling our founders now. Within the last 3 to 6 months, we went from grow, grow, grow,
Yeah.
which that was our incentive. You know what? It also wasn't horrible for founders at the time. It
No.
was not working. And you know what? If you raise more capital, you get a higher valuation. You then also have potentially more runway. And so if you raise in the last 6 months, hopefully you're in a better
Yeah.
position. We're telling a lot of our founders, it's kind of like dominoes. Like, great, the stonks fell. I call them stonks, stock market. And then the VCs are like, okay, the public comps are coming down. Well, then maybe our valuations might be too high. And I'm going to do some research on this. That once you got towards those very high valuations, it actually was a lot of hedge funders and banks, what we like to call tourists, that came in because their stocks were up. They had so much capital. They were doing 30, 40, 50% gains. And they're like, what do we do with this excess capital? Let's invest it in
Yeah.
other companies. And the different incentives were not aligned. Where if someone in PE or a hedge fund invest, if they get a 2 to 5x, that's phenomenal. If you give money to a fund, they 2x your money, that's awesome. A VC, though, when I invest in a company, I minimum want a 10 to 20x, which is still below what the expectations are because it also has to be outsized return. So I need 100x to make up for all my losses. Look, I'm batting probably about 75% right now in terms of like follow on capital. But we're the true diamond hands.
Yeah.
Most of that is illiquid. I'm waiting 5 to 10 years now, probably closer 7 to 10 years, for these companies to get acquired, go public, maybe some small secondaries if they can raise, but that's gone now. And so we're working with our founders, and we went from raise. We knew when I invested at pre-seed and seed what at the Series A all my friends were expecting.
Yeah.
Now I don't. And so fortunately, a lot of my companies raised about 6 months ago. So most of them are doing relatively well. Some are still growing. Some manage their capital well. And others right now are doing bridge rounds. So like at a pre-seed to seed, we call it a bridge, a seed plus, a pre-series A.
Yeah.
It's all
What
marketing and
about down
branding.
rounds? That seems to be unfortunately popular these days.
We're going to see a lot of them, and most people actually don't know how they work.
Yeah.
And so this is where it's going to get dicey in the next few months, because this is where the actual value on the books will decrease. So if you're a bank or a hedge fund, internally you have to mark down some of your numbers and tell your LPs on a quarterly, whatever basis. And so we're going to start seeing that happen quarter to quarter. From a VC perspective, they have all these massive markups. And there's different instruments. So if you're at a growth stage, maybe you did a priced round. So you actually have a valuation. If you then do a bridge round on a note or a safe, it technically isn't a down round or favorable terms that you have to mark it down. So this is where you can get creative. But there's Elizabeth from Hustle Fund on Twitter who writes these amazing threads. And so a lot of these early investors are doing safe notes or safe or convertible notes. And so if you're doing a safe, she did this amazing math that most people have never had to do before. And a safe has a cap, not a true valuation. I still consider if it's a post, it's as close to equity as possible. But then there's a discount. And so everyone's like, oh, I'm doing a note with a 20% discount, or I'm doing a safe with a 90% discount. The whole idea is you never need to use that. We're like, that's fine. Like the discount means nothing,
And
because if I
now,
raise above that cap, then I convert at the lesser of them. And so this is where it got interesting. So if you raise a 100 million cap and you have a 90% discount, the math, you could check it, is if I then, not a down round, I raise at a 105 cap, then what do I convert at? It's actually the lesser of the two. So I actually convert at, I think, a 94.5 million, because that's the lesser. It's 90% discount at the 105, which is less than the cap. And so there's going to be some fuzzy math moving forwards.
lost me.
Right. And this is not like rocket science, but you could start stacking notes and stacking safes. And that's where, at least at the early stages, you don't actually know how much you own in the company. And then it starts getting a little bit weird, but the company is a
I
living
know that
entity.
you would not invest in certain type of terms, right? Now, in retrospect, was that a benefit towards your portfolio? Because you were very staunch on not doing things, opposed to other people.
So our thesis is we invest below a 10 million valuation.
Yeah.
We didn't chase. There's so much FOMO, and it was hard. I'm like, great investors. I love this company and product, and people will debate all the time that price shouldn't matter. And sometimes that works. I have a friend, Kevin. He invested in an uncapped note, did phenomenally well on it. And that's just something I won't do. It's a thesis. I invest below 10 million valuation. I want to get in early. I want to work with the founders, and I'm in the multiples games. We're a capitalist. And so what Max is referring to is up until basically COVID hit, we did only price preferred equity, which now at pre-seed and seed is non-existent. We now try to do mostly post-cap safes. So there's a pre-cap and a post-cap. A post-cap basically means however much you raise, like that's the cap. So it's as close to equity as possible, because we know with a pretty certain degree of confidence how much we own in a company, but still safe. Simple agreement for future equity. I don't own the equity, and so I will convert into equity at a price preferred round, which is my goal. I invest in the company, they raise more money. I know that, like, yay, they should be profitable and control their own destiny, but like my goal at Angel, Pre-Seed, and Seed is that you raise money. Everyone's like, oh, how do you invest? I invest in founders, I invest in products, I invest in companies that will raise more money. I see great companies, and founders get somewhat offended when I say, oh, you're a lifestyle business. No,
Mm.
no, no. I can raise millions of dollars in venture capital. I will be $100 million business. I've seen them. I'm just not convinced. And so a lot of it is post cap safes. And I just met with somebody who is trying to figure out how to convert their early investors. They raised two safes at a low amount, a cap, and there's no conversion. So convertible debt has like 18 months I convert into equity or you have to pay me my debt. Safes generally don't have a timer.
Mm.
So this company is now profitable. They have EBITDA and technically is a valuation way above their safe. And they technically don't have to convert. And
Oof.
so that's a problem with the safe. If you don't raise follow on capital, you technically never get converted. And then it's up to the founder to kind of decide what they want to do. Everyone is nice. We want to take care of our founders and our investors. But now we're going to see actually a lot of work get done. We're going to learn a lot. It's been 10 years of exuberance, 12, 14. And now we're going to learn exactly how this market works.
Yeah, us founders,
Uh,
we are the ultimate diamond hands, right? And all these safe notes, convertible notes. I'm assuming founders want those type of rounds because of equity. Having a partner, you're immediately at 50% equity. Being a sole founder, you start at 100%. You got three founders, you cut that in three. There's four of you,
Then you
cut it
got
in
the ESOP.
four.
You have the employee stock option pool. So that's another
Oh,
10%
so
spread
that's what I
across all
was
of
gonna
them.
say. Yup, that's what killed me in the first time ever raising capital. Is your investors force you to open up an option pool, which comes out of my equity, and I just have to give it of 10 to 15%, and that's for future rounds, future employees, and essentially the way I look at it, it's my company's cryptocurrency, it's my company's tokens. That if I can't afford you, here's an $80,000 salary plus some tokens that could be worth more in the future. But we create the destiny. As much as you guys are the diamond hands behind the scenes, we're the diamond hands grinding the stones every single day to polish them. And it's incredibly difficult when you sell too much of your business in many cases. I don't know about the new financing in the past 24 months as I haven't raised capital in over 3 years, but I got a feeling it's getting a little bit more sharky out there. It's getting a little bit more loan sharkish. Terms might be changing because the demand for these rounds have gone down dramatically. I have a friend who raised capital, but in the end of the term sheet, it said something very bizarre, taking something personal from him. He owns some very cool NFTs, and at the end of it, it says, yes, but you must include your personal, NFTs. So I've
As like
seen
a
as a
liability.
liability. So it just became very weird and sharky. But as Trace mentioned in the last one, real companies will continue to get funded. This is the
Right.
hard part in both ways. Companies trying to get funded who've been funded in the past, but as Traces and I were talking about before, the mass layoffs. This is back to the 2008, where people now, we believe from the insider point of view, there's going to be mass layoffs because this whole growth and rebalancing of growth and maintaining back to the bootstrap mentality. There's going to be people who've been working at companies for too long who might get their new destiny after getting either pushed out or laid off, or for, I guess we don't use the word for long anymore. Trace,
Yeah.
what are you seeing out there?
So I just watched We Crash. I have one more episode, but last night, like it got me sad. It
Mm.
was the leading up to the IPO where they're going to go at 47 billion, 63 billion, and the employees are like, we're going to be millionaires.
Yep,
And so they start buying things on the promise that they're going to be rich, which technically,
on
for
paper.
all they know, is true. You're leading up to an IPO, you're weeks out, you're going to be rich. And so as an early member, and a lot of my friends worked there, a lot of them got screwed. It was really sad. Whose fault it is? Is it Adam too exuberant? Was it Massa giving him too high a valuation? Was it the times? You can blame anybody, but at the end of the day, it's generally the employees who get screwed the most. And it's really sad. And so that's one example where thousands of people
Mm.
had equity that just turned out to be nothing.
Turned into dust.
And then the other one that at least is more public because the founder made a huge threat on this is Bolt. So it's a one-click checkout. They were worth $11 billion.
Oh,
dollars. Unfortunately, they just laid off 27% of the company, which is just sad in general. But the founder did a whole thread about how his new program of giving employees a loan to exercise their options with recourse is like a double whammy. So a lot of people took out a loan that they couldn't afford, but they thought because their equity was worth so much, they could, but if they get laid off, not only do they take out the loan, they don't get the actual cash and liquidity. And so it's like a double whammy. So we all pushed back, and I'll pimp one of my companies called SecFi that does loans, a non-recourse loan. So they take all the risk. If it doesn't work out, you owe them nothing most of the time, depending on the risk. And so a lot of this education has to come to employees who, like us, aren't in it. We don't study this every day. And they also generally don't have knowledge of what's going on in the company, the burn rate. They can only read what they see in the news because public financials, the Excel spreadsheets of what is happening in the company isn't public knowledge. Sometimes it gets leaked. And so as a complete opposite example, just another company of ours, Tommy John's, which is half my wardrobe, we invested, I don't know, 10 years ago. They were a CPG company, men's underwear.
Yeah.
They've expanded into athleisure, everything. But they raised $4 million, and that was it. So they did 2 rounds, and then they controlled their own destiny. They became profitable. They took out bank loans, revolvers, which is what we're seeing with a lot of companies now, and they never had to raise more capital. So it's one of those interesting things where we knew their valuation when we invested 10 years ago, and even though their revenue far exceeded what their valuation was back then, no one ever marked it up. So that's one of the conundrums of VCs. If no one marks up your investment, you kind of have to guess.
Yep.
And so for the last 8 years until they announced a deal with a private equity firm, technically it was worth this much when it was worth this much. And so we want companies to be profitable. From an angel perspective, it's great. We don't really need these paper markups. But for VC, the last year, they invested at 100 million, then they got 500 million, a billion, 10 billion. On paper, they're looking amazing.
Yeah.
Now, like the tides are rolling out, and we're starting to see what is real or what was a little bit exuberant. But to Max's point about this new destiny, these startups the last few years couldn't hire the best of the best. They worked at the big tech
Yeah.
companies, or they were executives at all these major unicorns because they could pay better because they raised ridiculous amounts of money, and they had these amazing options that were worth hundreds of thousands or millions of dollars. And so the only real upside I see is now, where is the upside? At the early stages. So a lot of these major layoffs are going to be a boon for these startups that now can bring in some real talent. And so that's where a lot of my companies that are doing well, I'm sending them the list of layoffs, one, to help hire these people, but also get talent they never had access to. And so this is where, like we like to say, the adults are now coming back
Ah,
in, some of them, to run startups where they had 10, 20 years experience that you could never afford, right? If you want to be an engineer, you can go work at Facebook, Google, Amazon for $250,000 plus $250,000 bonuses and stock options, RSUs. Now they want the upside. They worked at a growth company. They want to come back to startups. So this is what we're going to see over the next, I still think, 3 to 6 months, as more and more companies can't raise funding, bridge rounds, down rounds. They have to extend the runway until the collective human behavioral mentality is like, okay, I think we bottomed, but all these people want new jobs. And so I am trying to get a lot of these people to join my startups
yeah.
or start their own companies. So this is where we're going to see become really interesting in the next 3 to 6 months as we see the shakeup and where these people go.
A lot of these,
Uh,
top executives are now, second time founders, even though they never, technically might have found a business. When you see the internal infrastructure of a massive business growing faster than anybody could imagine, and then see the collapse, right? And it's not the collapse based off of anything's really changed in your business, but just the outside world. And founders' point of view, this is the time to shine. This is the 2008. This is the time to see what you're made out of. And as I mentioned in the last podcast, it seems cheaper than ever to start a business. At least get
yeah,
get the word out. And just what I've noticed of this new generation of VCs and angel investors are they are younger founders of companies that have exited within the past 10 to 15 years. And they are, not to bash anybody, a lot more helpful, right? They understand fulfillment, they understand logistics. They're not just an old software team that sold in the during the .com ages. So we've been getting a lot of value add from our younger investors as they've been there and done that in today's modern times. So
Yep.
hopefully,
All
these
right.
employees could come on out and iterate on what they've been working on anyway, but their version of it.
Yeah. And so with that, we're going to transition over to our emails. So this was Max's idea. I love it. We're going to go down some of our last few emails of like basically real time.
Yeah.
And so one that just popped up this morning in my email was from Techstars, a new pre-seed pre-accelerator fund, which is kind of mind
Yeah,
blowing.
what?
Right, you have to like pre-seed pre-accelerator
Yeah,
fund.
what's up?
I'll dive into the news later, but just reading that headline, it makes sense because accelerators are everywhere, incubators, accelerators, and what is their true value add? They bring investors. For the last 2 years, did you really need them? And so I watched the demo days. We've invested in a few from Techstars, ERA, Y Combinator, all over, but now everybody has one. And so the other problem is all these VC funds, one, started moving downstream.
Mm-hmm.
They raised like a $500 million seed fund. So they're throwing $3 to $5 million checks, which means nothing to them at like a $20 million, $30 million valuation, which forced us, the angels and pre-seed, to go even earlier.
Mm-hmm.
And so now, what do we call it? The pre-seed pre-accelerator, right? It's like before you even go to accelerator, we're going to fund you because we have to keep taking on more risk, more earlier bets. Like half my investments last year were already pre-product,
It
pre-revenue,
feels like investing
which
in
was
penny
kind of,
stocks.
it's like the pink sheets. That's basically
Yeah.
kind of what we're investing in, right? Like not Wolf of Wall Street, but like even earlier, like they really don't have anything. And so that's where we're like, yeah, we bet on founders because that's all we can really bet on.
Yeah. Yeah. And that's where being a top executive at an old company or, being a second time founder is so important, especially during these times.
Yeah.
My last email is it's not a good one. One of my warehouses, there was a little bit of a, mishap, and I've learned that these warehouses, it's about finding a warehouse that sucks less than the other one.
Yeah.
And I was just explaining to Trey something that I would have never, ever, ever thought of doing. I'm thinking about doing with an Active A at this point. Our fulfillment centers cost me this much. It's this much of a hassle, but we also sell on Amazon and Amazon FBA. And we just signed up for the wait list to be completely fulfilled, even our own personal website, by Amazon 1 day, 2 day delivery. It makes us a powerhouse. Amazon's cost, the more you send, the cheaper it is. Somehow, I don't understand, but whatever. And the reason I would never do it is because, they get my data and they control some of my destiny. I want to control as much as possible. But the pricing during these trying times, my margins almost double using their fulfillment centers.
That's such an unfair advantage. So another email close to the top. I read a bunch of newsletters every day. I read so much. Is Dan Premack, his Axios Pro Rata, 100% sign up for it. This one titled timely, as we discussed before, time to bolt. And so this was something that everyone unfortunately was kind of not cheering for, but the founder just started doing all these threads and getting aggressive and then left. And who really knows what happens? It will all come out in time. But there were this one-click checkout. There was a company, I don't know, a month or two ago that shut down called Fast. And so that was their direct competitor. And this is just the news because it's timely. It was very public. And it was a highly fought after round. The founder raised billions of dollars. I think he raised $1 billion back in like October, an 11 billion valuation. And so there are so many companies that even I have never heard of when they raise capital. And I read the news all the time. I'm on Twitter. I follow all my VCs who are humble investors when they make round announcements. But this was in the news every single day. It's kind of like our paparazzi, our celebrities. And this is where watching We Crash is, I think, so well done, where they have the founders and it starts off as this idea. You're so excited.
Yeah.
They have their green desk and like they have one, but then they have to scale. The VCs invest, they get a little egotistical, which is fine. You're building a company and PR is our background, our family background, and you use it to your advantage, going on the cover of magazines, Vanity Fair, CNBC, TechCrunch, News, New York Times, like getting coverage. It's good for you. But at some point, you have to become like larger than life because you're managing the press, the ego, relationships.
Yeah.
People always ask, like, what is my job? And I tell them a part of it is literally marriage counseling because it's a marriage between your founders, between your employees, between your investors. And you have so much at stake. It's so much pressure for a lot of these founders where I feel
Holding the
bad for them
whole
sometimes.
world
I
on
try
your
and be
shoulders.
right. You're like your Atlas holding up a valuation, your
Mm.
employees, all of your agreements, all of your debt. It's all technically in your name. It falls on your shoulders. And we joke that you need to be a benevolent dictator. You're in control. You're the
Yeah.
CEO. Yes, you kind of answer to a board. And as they showed in WeWork, they approved everything because the founders in control. Technically, they're on paper worth a lot more than they invested in. So they want to stop them. It's kind of working. But going to an IPO, direct listing, getting an acquisition, it is so hard. And so I just want to also just pour my heart out for a lot of these founders, what they're going through. And now the investors were like, it's so easy to raise money. And now they're like, well, maybe cut back. But what is cut back? It's firing, cutting back on budgets, and trying to figure out where you can extend your runway, how to keep your company alive.
This is all while building a business in distressing
Oh, yeah, that
times.
too.
Oh,
Yeah.
I mean, what I've learned, throughout this process, and I've been taught, we'll get into email real quick, but something I believe is so important during these times is I am Maxwell. Peel-aways is Peel-aways, right? A lot of people say it's your baby, and I go, no, it's a company that I run. And the reason I have to differentiate them from me, if my company's failing, I'm not failing. It's just the trying times. And so you almost put the emotion, two different types of emotion, that you have to put off to the side because firing and hiring, I love my employees. I cry more than they do when I had to let them go. It's really, really hard. I'm not sure how else to put it. It never
Yeah.
gets fun, firing and hiring. Hearing about people's health, family members all across the board, and you're almost a therapist while needing a therapist 5 days a week.
Yep.
So it's really, really tough. And so, what can we do as a founder? We try and pick the lowest hanging fruit that we can. So that leads me back to my next email. We'll just do 2-3 emails today. It's A/B
Yep.
testing. It's an A/B test across the board. I have one team just trying A/B testing on email, and then just Amazon and a few other places because I believe this is the lowest hanging fruit. And during these times, instead of $10,000 on advertising on Facebook, I'd rather spend $10,000 on my email marketing SMS and make sure that I can get something called the lifetime value of my customer to increase.
LTV.
LTV. That's what this business has turned into, subscription and LTV. If you have a one-off product, it's going to be incredibly hard. You need to have customers that need your products or at least want your products enough to come back and purchase them again in this environment. So go back to your most loyal customers, give them whatever discount makes appropriate, and keep them on board during these times. And get them to spread the word by word of mouth if possible. There's nothing more powerful than somebody recommending a product that they use themselves.
So, yeah, and so I just want to build on that and with this, basically saying one of my best investments, the founder is maniacal about every penny. And so I know his financials just as well as he does because every single month I get an update, 15, 20 pages of what's going on in the business. Every single metric is tracked. And it's a red flag when I see these pre-seed seed companies raising $1 million and 40 to 50% of it is going right to advertising, sales, and
Oh,
marketing. I get it. You have to build a product and you have to market it in sales. And that's fine if you actually know what you're doing. And so, as Max was saying, A/B testing. This founder, his team, and who he's hired are amazing. And they literally A/B test just to squeeze out another point, another
ABCD. Yep.
1%, 2% margin. Why? Because that's business. And so if you have a funnel, you have to know what your CAC is. And every founder at Pre-Seed says their CAC will go down over time. It's completely wrong. It will only go up because as you get better, you have to start getting the fringe clients who are harder to get. And then also Facebook changes their algorithm. Apple did their privacy, which made it harder, which is potentially destroying the advertising world. Snap just announced
Yep.
that they might miss numbers. They tanked $250 billion off of the stock market. And so advertising, where's it go? How does it work? A lot of people just have huge budgets and they spend money and they know that it might equate to sales. You can kind of track it. And so we always ask founders, if you turned off your marketing now, how much would be organic? Like drop off. We tell them experiment with that. But as Max said, and it's so important, you have to hopefully spend $1 and actually make $1.1, make more money than you spend. And yes, at the early stages, you have to show growth, that there's a market. But at the later stages, this is the whole growth at all costs. You're buying customers. You spend money in advertisements and you buy these random people out in the ether. You don't know who they are, and hopefully you can track them. And so that's so important. And it's a red flag when we say, do you actually know how to buy ads? Are you hiring an agency? That's fine if you can figure out the economics of it and hopefully make more.
Yeah.
And so, look, I get a pre-seed and seed. You're not going to be profitable. I know it should be an expectation. It's not. And cash flow, EBITDA, adjusted EBITDA, community adjusted EBITDA. And so that's one thing that we always ask founders. Do you have this experience? Do you have this unfair advantage? Do you know what you're doing? And look, you can learn along the way. That's fine. But at some point, you have to be in control. As Max said so brilliantly, control your destiny. You are in charge. We're investors. We say we're humble. We hopefully add some value, but you tell us what you need and you go out to the market and you do it.
I'm the one that wakes up
So,
7 days a week breathing this stuff. People say they want to start businesses so they could be flexible.
no,
I bow down to my customers 24/7, 365, and I'm the CEO. It's very bizarre. And then the last but not least in this environment, I bow down to my employees, the people that work for me, the
yeah,
people that are actually helping me. And then I do the opposite. I get rid of the people real quick that are creating any friction that isn't positive. So with
yeah,
that, we'll end it there. We appreciate Trace coming on today and making time to show us the experience of just the last week's worth of knowledge.
yeah. So with that, we're the Start Brothers, and we'll see you soon.
Week by week, everything changes. Stay safe out there.